Long-term trends. I want to talk about long-term trends in this video and share a couple of charts that are very long-term, like a couple of decades. Stocks are right now high overvalued, overpriced because there's a lot of money oversupply, M1 and M2. Because the government is printing a lot of money, it's all moving into the stocks, and with that, they are kind of overpriced or overvalued, you can say, because all the money that's being printed is going there. But I want to talk about looking at the charts long term, like a couple of decades, because generally, we don't think or see things like a couple of decades. So this is a way to look at not only charts, like in terms of finances, but other things too. So here I want to show the Wilshire 500 to GDP ratio, which is the Wilshire um, index, which is very accepted as a benchmark of US. It is already overvalued, and as you see, it is higher than 2000 year and even before. So it is way overvalued as per the chart. The source is from long-term trends. There are a couple of other sources, but long-term trends is where I'm showing this chart. So if you see, it's way overvalued, but overpriced. But Wilshire index is one of the one which Warren Buffett is its most important measure of how he values, how he thinks the market, the market is, if it's undervalued or if it's overpriced or underpriced compared to the value. There's also another Buffett indicator, which is the market equities total market value of the total market equities, and it's only published quarterly, but it is having a lot of history. You can look, even if you look by that, it is higher than the year 2000. So both are showing they are in a bubble, kind of overpriced category. So with those charts, you can see there are a couple of decades, and if you're not seen thinking like right now, it gives a perspective of the past, like is it undervalued or is it reasonably priced or is it way overpriced? But that's just one indicator to consider. Okay, so I'm gonna show you now the M1, which is the money supply. The total money supply. M1 is all the cash and the checks. All these are circulating in the economy. If you see in this just last year, 2020, so much money is being printed, and it's all being funneled into the stocks. So all the, if you see the chart from a couple of decades, the M1 money is at the all-time high. And let me show M2 as well. This is M2, which is all cash checks plus all the CDs deposit, bank savings accounts, checking accounts. So it's way higher. So all the money supply is showing it. This is M2. So all the people who getting extra, who have extra cash, well, it's all moving into stocks. And let me show you the long-term chart of stocks versus other assets. So here you can see compared to last couple of decades, stocks always outperformed other assets. When you think of stocks, it's one asset class. Real estate is another asset, and there are a lot of other assets like bonds. But if you compare, stocks always outperformed other stocks. I mean, historically, if you see, except there is during a couple of years. But if you look over a long period of time, stocks always outperform because they have other characteristics like market versus gold, silver, bonds, which are a little bit more safer than stocks. Uh, and I'm going to show stocks versus bonds, the long-term chart. So here, if you see, stocks still S&P 500 to bonds. Uh, so stocks still outperform the bonds. So because bonds are a lot safer, bonds, if you know, They give interest. They're very safe. They're fixed instruments versus stocks, which are equity. They have other characteristics like going higher depending on the market and growth. So stocks outperform bonds, metals, and all other assets classes. And I want to show one more chart, long-term chart of growth versus value. In the 2000 bubble, growth stocks, like all the tech stocks, all the growth stocks outperformed. Even now, if you look, growth stocks are still overperforming value stocks, but they're not for everybody. But if you're advanced, you can select and choose growth stocks that you understand very well. But value stocks have their own place, but growth stocks are still outperforming value stocks over a long term if you look. Let me go into one more chart. Emerging versus developed markets. If you see, the US market is doing on fire, it's doing very well compared to developed markets. But in the past, in 2010, in 1994, developed markets were better, as you see. If you are looking at some Asia, some stocks over there, there may be some value plays. Also, there are higher GDP growth. So if you understand very well, you can select some of them for value versus like US where everything is developed market, the return is higher. So the developed markets are not doing that well now, but they provide good value compared to GDP ratio, GDP growth. So if you're advanced, you can select some of the emerging which are not doing that well, but on the valuation point of view, they are a better value. And finally, the Wilshire GDP ratio, which is the uh, Warren Buffett indicator. I think the next one is Buffett indicator. Yeah, the Wilshire indicator is the long-term indicator of value stocks, and Buffett said this is the single best indicator of how to look at the valuation. And you can see it is overpriced compared to even 2000 bubble. And the Buffett indicator is the ratio of the market of all the equities to the GDP. And if you see, it's even higher than 99. So the TEL stocks are overpriced in the bubble category, but you can choose to go to cash or stay if you're in index funds, depending on your situations and goals. But all of the charts are saying we are in a bubble. We are very overpriced. There may be some correction coming down, but we don't know when. But if you look long-term charts, they give different perspective, and you can start looking at other things about index charts to get an idea of the long-term charts uh, to see to compare whatever you are looking at.